Good morning. I'm David Ruffin. Welcome to this Friday's Coffee Talk Q&A and Banker's Perspective on Loan Level Stress Testing for IntelliCredit. We're delighted to have you on this Friday. One of the things that we love to remind people of is that a coffee talk, unlike a more formalized webinar, is indeed about interactive participation by the registrants. And so we certainly look forward to that. Our panelists today, in addition to myself, will be Larry Poole, who is Managing Director of IntelliCredit, but most importantly, really the architect of our stress test methodology, which he'll certainly hear. And a special guest for us is, of course, Lynell Deloach, who is Director of Credit Policy at Blue Ridge Bank in Virginia. And a little bit more about Lynell in a little bit. A little bit of logistics. Attendees will be muted. We would not be able to hear you, but please use Q&A or chat. I think most people tend to use chat for questions that they have, either technical or substantive. Again, we look forward to hearing any thoughts you might have and perspectives you might have as bankers on stress testing. There will be the deck will be sent out probably about Monday to all the participants. So if we get that question frequently, would the deck be shared with those that are participating in the coffee talk today? And that answer is, of course, yes. So in the spirit of encouraging participation from the audience, we're going to have about 3 or 4 polling questions interspersed. So before I get into my perspective about, or our perspective about the credit environment, we'd like to get your sense of. You've obviously got 3 options here. Is it improving? Is it deteriorating? Or is it uncertain at this point? So we'd love your perspective on that. Give it a few seconds to get people to respond. Great. So I think that has been, unfortunately, the common word or the operative word that has, for the last, frankly, the entire time IntelliCredit has been in formation since 2019 is uncertain. And it usually comes from different perspectives, right? Whether it's the pandemic or what have you, rate situation, currently the tariff situation, who knows? But the point being is, I think everything I'm seeing, and I've been to spoken at 10 conferences since January 1st, that seems to be the overriding theme is uncertainty. Okay, so my sense of trying to share a little bit from perspective is kind of serve up the premise for today's coffee talk. What is the current credit environment, at least from our perspective? There's certainly no question that some of the industry elation back at the end of last year and the very beginning in January of this year was that there seemed to be a lot of hope for some rate reductions, even inflation reduction, that the election results would change some of the policies, particularly as it relates to regulatory relief. I always believe that primary relief on regulatory would be more in the compliance area than safety and soundness, but we don't know yet. I will say this, that in our loan review work and in our discussions with people at trade conferences all over the country, there does seem to be a bit of a delta or a divide between the C-suite perspective of where credit risk is and what I call the working lenders and the working credit people. The latter group seems to have more angst, more concern, more feeling that there is already some signs of emerging credit stress. But, I think all of us on this call would agree that credit is a long game. It's not, our financial mindset, our financial press is dominated by kind of a Wall Street lens, which is, what have you done for me this quarter? That's not the credit world we live in. It's much more of a longer game. And even if rates change today, it's going to take a long time to get through the pipeline in terms of affecting credit quality. More specifically, what we see from our perspective is the public metrics that are published through the call report are still showing relatively benign performance. There's some uptick in stress, but as we all know, that's a trailing indicator. There's no question that there's growing uncertainty, as you all supported that in your polling questions. We're certainly seeing where rate and inflation shocks are beginning to have negative credit implications on specific borrowers. There is one thing that's clearly emerging that I think that bankers need to accept as reality. There is CRE segment obsolescence. I picked that term up, frankly, from California bankers. They're dealing with issues like vineyards, other things. Real estate is very local, but the digitized world we're living in for several reasons are changing the use, frankly, of real estate, and I think we have to accept that as bankers. There's no question that growing sentiment, negative sentiment is growing, particularly among the lenders. Even the national surveys by the regulators are documenting that. We are certainly seeing the largest number of downgrades in the past several months we've seen in almost a decade. I think that in talking to some of the investment bankers, and we stay close to them, is that they are now beginning to fear that uncertainty to them is not good for M&A activity, frankly, and that is that they think credit risk may actually be replacing the rate risk, which really stymied a lot of M&A activity in the M&A space the last 2 or 3 years. There is no question that, at least from a safety and soundness standpoint, we have certainly seen a tremendous amount of focus on what we call credit process, not so much going toe-to-toe with bankers on individual relationship transactions, but credit process tends to be the primary focus. As far as delinquencies are concerned, we've really, unfortunately, the Federal Reserve and the national regulators usually are well behind in terms of, but the third quarter of 24, our delinquencies in commercial banks, all banks, have almost reached the level of the pandemic. For commercial lenders, and I presume most of you on this call are more commercial oriented, the good news here is that it's the consumer purpose lending that is by far leading at this point in terms of delinquencies. The last thing that I'd like to focus on is reserves. And I think there's an interesting story here. We traditionally try to break up our analytics that generated by our sister division, Quick Analytics, into regional banks. And I want to reemphasize, we capped this at $10 billion on the presumption that if you add in a lot of mega bank data, it really would skew the numbers here and make them, frankly, meaningless to a lot of the community bankers. But as you can see in the NPL, which is non-performing loans to loans, there's a beginning to be an arc upward in that. It appears that the Southwest banks are actually leading somewhat in trouble loans as well as charge-offs. As you can see, charge-offs are heading a little bit north as well. And then you see the ACL, or the allowance for credit loss under the new CECL methodology. You see that declining as well. And the interesting thing here is there is a big divide between, say, some of the banks. Certainly the Northeast banks are actually showing under 100 bips in terms of allowance provision. And I've been around a long, long time, as you can surmise, and it's very difficult, in my opinion, irrespective of the methodology, for regulators to get real comfortable if you're under 125 basis points, at least in terms of being able to explain your comfort for being that. Another way I look at this, and frankly, a preferable way to me to look at it, is rather somewhat inverted, and that is how much of your inventory of problem loans are you actually covering by your reserves. And this is the big story for me, and that is it's declining significantly, or quite a bit. It's actually going back to the days of before the pandemic. But the reality is that the community banks' decline is outpaced even the total banking industry. Now, the main reason for this is that the coverage ratio is declining largely because we are identifying more non-current loans. So it's just a fractional calculation there. So I do think reserves, community banks are beginning to indicate in the last, I believe in the last quarter at 24 that they were beginning to up reserves, largely because there was some anticipation of heightened credit stress. I did mention the CRE as being certainly a major concern. The main reason, of course, is a disproportionate amount of CRE at the community bank space. But it's not about the typical 300, 100 that we all know about it. I think the real focus needs to be on the subsets within those broader guidance levels. So I often like to, when I'm speaking, I like bankers to tell me where are your primary concerns on the subsets of CRE, not just CRE in general. So please take a few seconds to respond of what of these CRE subsets give you the most concern at this point. All right, we'll show the, well, I think that's very interesting. Everyone knows about office. I will say this, the good news here is most community bankers are not as exposed in office. Um, I am very interested that you've identified hospitality. I heard an expert say 2 or 3 years ago that hospitality was going to be in for some rough sailing, particularly after the boon of liquidity coming right off of the pandemic. There's every indication that's showing that that's the case right now. And there was prediction just yesterday that Americans are making some stark changes in their plans in the next year or two for like summer vacations, worried about cost of living and things of that nature. So I will say multifamily does concern me. Part of that's because I think there's a lot of inventory of multifamily that's been built in the last couple of years. And traditionally, multifamily explodes when 1 to 4 family mortgages are struggling. And I think we all understand what the rate shocks have done to the 1 to 4 family mortgage business. They tend to be like seesaws. But what happens traditionally in our industry is that the multifamily then becomes overly supplied, and then you have issues credit-wise in that sense. Okay, so at this point, let me go to the segue to really what our agenda is today, and that is I just want to remind the viewers that IntelliCredit really represents 3 primary pillars of post-booking credit risk management. Portfolio analytics and loan review, and of course what we want to talk about today is stress testing. And in that regard, what we'd like to do is ask you to, and of course stress testing is largely divided in the industry between the vernacular of portfolio level stress testing and loan level stress testing. Portfolio level is usually driven, of course, by call report data or public data. Loan level is your idiosyncratic DNA, it's non-public, but it's related obviously to your individual bank. In the last year, have you had portfolio level, loan level, both, or neither performed at your bank? Right, we'll see the results. Interesting. That's about the pace I'm seeing in other meetings that we've asked this question. So thank you very much. All right. Well, now you really are, we are at the point of the reason we're here. And now I'll hand it over to the real experts in this. And that is Larry Poole. Please feel free to take it from here.
So I'm going to walk through 3 or 4 slides and then introduce Lindell, and then we'll kind of jump into it. Something interesting started happening to us really around second quarter of 2024. We did about 150 loan reviews last year from banking clients across 30 plus states. And a lot of those exits and just regular cadence of business, we started getting questions from banks. Do you guys do loan level stress testing? And it was kind of really irrespective of asset size too. A lot of times you would think of that for banks. You're not required to do it until you become a mega bank, but it wasn't just billion-dollar banks asking us that or 750, even 250 million, $100 million banks asking us about loan level stress testing. And what we realized is that across all regulatory bodies, one of the things that they were talking about increasingly during their exits were if you had a certain level of learnings have really been benign the last 15 years, what would be the overall impact to your capital position? It became a talking point for banks that had high credit quality, intermediate, low credit quality. They started giving the mandate, we think you need to increase your loan level stress testing. So last year we rolled out a loan level stress testing model. And just to spend 30 seconds on this slide, one of the things that we really wanted to do as a firm is make it high value for our banks, but also really minimally intrusive. That's always been kind of a working thesis for us, that we want to partner with banks, but not make it hard for them to get actionable results. So during our loan level stress testing, we really only need two things from a bank. That would be your core system file with a list of loans, and then also a list of impairments and reserve amounts as of the same date. We will spend, if we do some demos with banks, follow-up calls from this, really diving a little bit deeper into the methodology. But at a real high level, the first thing that we do is we segment a bank's portfolio into one of what we call risk cohorts. And those are listed here: construction, commercial and industrial, CRE, residential mortgages, and then consumer. And once we do that segmentation, every loan in a portfolio is assigned a probability of default and a loss given default. And I don't want to bore everyone on this call with technical details, but a PD LGD stress test methodology is really a forward-looking methodology, whereas a net charge-off stress test methodology is what has happened historically. So a very easy way to think about this is a probability of default is what is the likelihood that a loan is going to go bad or go to non-accrual in the next year? And then loss given default is what is the severity of loss if a loan does go bad? What percentage of the balance should we expect to charge off? So every loan in our methodology is assigned a PD and an LGD. We forecast losses across each loans across three scenarios: baseline, that's kind of realistic expectation of loss, all the way to severely adverse. That would be more like alternate state of the economy. And once we have those kind of three loss ranges, baseline, adverse, and severely adverse, we're able to marry those with some simple capital assumptions, things like 2-year forward-looking pre-provision net income, dividends, historical tax rates, and we're really able to come up and say, if you would experience these levels of loss within your portfolio, what's the overall capital cushion for the bank? So if we can go to the next slide, this is taken from just kind of our report. There's two deliverables that kind of come out of this methodology. There's a management report, which shows key findings and some action items. And then there's a loan level Excel workbook that we provide. But this is one of the charts that gives you just kind of a baseline of the summary results of our credit loss stress test analysis. So what this is showing here, if you look at the second column, this gray that says portfolio balances, down at the bottom, this is a $1.3 billion loan portfolio. You can see over to the left the various risk cohorts, and either further segmented by FFIEC codes. And then this green, yellow, and red columns are those baseline adverse and severely adverse losses. So for this bank, this $1.3 billion portfolio, in our baseline scenario, we're projecting 11.6 million in losses, or 87 basis points. And in our severely adverse stress scenario, we're projecting $55 million of losses or 413 basis points. Again, the severely adverse is we're flexing up all the levers, and then with those levers flex, what would that do to the bank's capital position? So if we'll go to this next slide here, this is kind of the summary capstone of the entire report. We say if you experience these level of losses, and we include some capital plan assumptions, which we can either take from your capital plan if you have one, or we can use historical call report data if you don't have a fully baked capital plan. But these green highlighted sections at the bottom, your 5 key capital and leverage ratios, you can see how you would perform. So if I just jump all the way to the right here, in the severely adverse scenario, we've basically projected $55 million in losses over each of the next 2 years, which would mean the bank would have a net loss position of 34 million in each of those years. But if you look at the ratios below, even in these pretty draconian scenarios, the bank still remains adequately capitalized. So the main takeaway here is we've gone through this analysis as the bank. If I'm sitting as the president or the chief credit officer or the CFO, is I could easily say, look, we've gone through this robust loan level analysis. Historically, we've lost $12 million over the last 2 years, but we're showing you that even if we lose $100 million over the next 2 years, we would still remain adequately capitalized as the bank. So that's a very just another robust tool in the credit risk tool set. And one of the key takeaways, one of the best things that can come out of this demo is we would like for you to get in touch with it, and we can discuss your individual needs as a bank, because we can model losses a lot of different ways. If you've got, let's say, a big SBA portfolio or Banker Healthcare Group loans, or we did one bank and they had a large premium financing portfolio, we can model these results specific to your portfolio. If we'll go to the next slide here, really excited about this section, the Q&A. I want to introduce to everybody Linnell. As we've already said, Linnell is the current Director of Credit Policy, Governance, and Innovation at Blue Ridge Bank in Virginia. From what I've seen of Linnell, her role really bridges credit, regulatory environments, and even serves as a liaison to the finance group. Linnell also brings a unique perspective because she has been a chief credit officer and just a really deep credit mind, but her skill set really bridges both sides of the bank's balance sheet. So just a profile on Blue Ridge Bank, headquartered in Richmond, Virginia, 2.7 billion in assets, 26 branches across North Carolina and Virginia, and just recently completed a $150 million capital raise in 2024. And our analysis, our last stress test for Blue Ridge, was right during the middle of that. So that was a little bit of fun for me, because we also got to model some of those capital assumptions, which we knew were coming. So Linnell, just wanted to welcome you, say thank you for joining us today. And did I miss anything that you would like to add to this introduction, which really didn't do you justice?
Oh, no, you're great, Mary. Can you hear me okay?
Yeah, we can hear you great, Linnell. So thanks for joining us today. One of the things I've known Linnell for a long time, really worked pretty intensively in spurts as we've done consulting engagements. And one of the things about her is she feedback from her has really helped us build out some even more capacity internally here at IntelliCredit. So just a reminder, now we're going to transition into the Q&A section of our analysis. So as you have questions, please feel free to type them in the chat, and we'll get to them. A couple questions that we already had that I wanted to go ahead and kick this off. The first one here, Linnell, just tell us a little bit about what was some of the key decisioning for Blue Ridge to pursue loan level stress testing specifically when we started this conversation, I guess back in really the third quarter of last year.
Well, while problem credits are routinely the focus of risk management, the potential effects on credit concentrations came into the purview on different portfolio segments. And so we try to focus on our portfolio loan stress testing as a result. And so obviously the OCC supervisory guidance says, that I like to quote and make sure that we're compliant is that, they're expecting that we have insights about our portfolio that we can share with bank management and make the information obtained from the stress test both apply to strategic and capital planning initiatives so we can better understand our capital at risk.
And you guys were doing lots of not just bottom up loan level stress testing, but even top down things.
Mhm.
I don't want to put words in your mouth, but you guys have really a robust. It's not just a single one size fits all model for all banks, correct?
Correct. And the reverse.
Yeah, reverse. So reverse stress testing, you mean break the bank. What level of loss do we have to experience for us to become undercapitalized, right?
Right.
And just kind of jumping into the second question that I'd sent you here, like how was that received by your internal stakeholders, whether the board, executive management, regulators, when you were able to share not only our results, but just some of the other types of results for stress testing you were doing?
I would say the stress test served like a validation for us and executive management, and the fact that the results we received, especially for the second one, so this is the second stress test we've done with IntelliCredit, and those expectations were used to target loans that were primary drivers in the adverse and severely adverse scenarios. And I can talk about a little bit as it relates to the capital raise and all of that, and using that information to help be strategic in understanding which loans we needed to target first,
Yeah.
and how impactful they were to our capital and the cost of capital.
Yeah. So one of the things that I remember specifically about the analysis that we did last year, it was like me, you, CFO, some folks in accounting, chief credit officer, and we flashed this one chart up on that we always do during our exit, and it's really our top 25 loss drivers. We didn't show that here today, but like as soon as we flashed that up, everybody that was credit on the call started saying, ABC borrower, this is what's going on with them. The next borrower, this is what's going on with them. So, and I can remember being on that call and said, okay, this is exactly what you want from a credit risk management team. You don't want to ever flash that chart up and, hear crickets. Here's your largest loss drivers, but I don't know anything about these. So yeah, speak to that, Linnell, about kind of just targeting that in lieu or in anticipation of the capital raise.
Sure. So we were using this for multiple reasons and not just from credit risk management. So we had been doing capital stress testing separate and apart from a loan level stress test. So we were trying to blend these together because we were not, our current stress test on the capital plan was not specific to specific asset classes in the loan portfolio, particularly as it related to commercial real estate and other material or high risk segments of the loan portfolio. So this, as we were going through at the time, I don't think the definitive purchase agreement had been executed, but, there was obviously a plan for an asset resolution plan. And so we were using this information and layering it into what was going on real time. And that information was actually used not only in that moment, but now we are revisiting the strategic plan because of the success that we've had. And using this information. And that's just something that was really important to take into consideration during the capital raise, as well as using it to compare the various scenarios in the ACL to evaluate the adequacy of the reserves.
Yeah, I know one thing that that we spent a lot of time on the front end before we even did the modeling. So just kind of out of the box, when we do this, IntelliCredit suggests here's the 5 buckets that we've already talked about, these 5 risk cohorts. Construction, commercial and industrial, CRE, residential, other, consumer. That works for most banks, or almost all banks that works for. But one of the things your executive team, I remember our first kind of discovery call we really harped on was, look, these buckets are fine, but we need you to subset this to match our ACL.
Yeah.
So one of the things that was cool, you just shot me over the ACL memo, and we were able to do that. So not only while this doesn't obviously receive the level of scrutiny that your allowance for credit loss model does, it was a cool like challenger model to say, our ACL reserve and this specific product type is this, and the stress test here it is across 3 scenarios. So you really did have even though the methodologies are completely different, you did have an apples to apples, which I thought was interesting. And to be honest with you, I've kind of stole that every time we've gone forward, asking that question, like, hey, do you want us to make this look just like your ACL bucket? And really 100% of the time I've gotten the answer, yes, let's do that. So I appreciate you sharing that, Linnell.
Larry, excuse me for interrupting. Before you leave this subject, I think one of the things that we find very important at IntelliCredit, and hopefully Linnell agrees with this, is that the real beef against stress testing by a lot of bankers, understandably, is it's just a theoretical mathematical exercise, right? And what's the real value in that other than doing a checklist under, if the sky's falling? The point being is that we felt from the get-go that if we didn't produce those, as you said, Larry, those top 25, top 30, top 15 relationships that may be even more problematic under these various stress scenarios, then it's still a theoretical exercise. So I appreciate the degree to which Linnell just described how you're using it.
Yeah. Very much so. That we did talk about a lot of those, and I was basically an observer. It was like an internal, getting to sit at the board with Blue Ridge and on the exit call and just hear y'all talk about all the credits, which was kind of neat. Just really before we kind of go to audience questions, last question I just had for you, Linnell. Would you, and this is a bit of a plug for us, but please, be honest for the group. Like, how would you describe the process of just working with our team? Not only understanding the methodology, but just the time intensive nature of it. Was it manageable? Kind of how would you constructive criticism or compared to other vendors, how is it working with our team?
Well, I would say it was extremely efficient and effective for what we needed. Y'all are great collaborators, very careful listeners, quick to respond. Obviously, I always have questions. And for those on the call, that's true. And if there's concern, so I came back multiple times, saying I'm layering this against the supervisory guidance, how should we handle this? And, it was very much a team effort. And, I very much view this, one, it was successful, and many times, as David stated, it can be sort of a pass or fail. And that it's a theoretical what if scenario, but for us in the moment, especially the second time around, it was a real exercise, real time, that had these capital implications, and how were we going to use the information. And so y'all's ability to provide the timely report in the moment was extremely helpful to the cause. Thank you.
Yeah, thank you for that. We were doing some of this over December around Christmas, so it's
Yeah.
I was like, Merry Christmas, here's your lost reserves.
And Larry, we do have one question from a participant that very pertinent question. How often are loan level stress tests recommended to be performed?
I'll give my perspective as a consultant, Linnell, and if you would jump in and offer yours as well. For most banks, I feel like the cadence for a loan level stress test is about the same as a loan review or an ACL methodology review, which is about annually. We do
Mhm.
have larger clients who have historically asked us to do it biannually. We've even done this quarterly before, which it may be great for your bank. It really depends. But annually works well for most banks for the loan level stress test to give you actual insight, but also for regulatory compliance. Linnell, I don't know if you feel differently.
Yeah, no, Larry, I agree. And I think the only additional thing I would add is that if you have changing tolerances, or there's something in your book that's happening real time that you need to adjust your strategy or plan for, it may be a good time to layer that in, even if you do annually. And ours just from a timing perspective worked out. But, I would say that because it's really important to overlay the results with other things, including the budget, um, as you plan and go forward.
You've
Absolutely.
touched on this a little bit, Linnell, already, but another question that's kind of close to my heart because unfortunately, been privy to a few regulatory orders in the last year to banks to improve their credit process, as I alluded to in the intro. But the question is here, how much strategic changes have been made because of a stress test, or have you all seen any examples of that? And I'll comment in a moment about that. But the linkage to any impactful strategic change that came out of the stress test.
Yeah, I mentioned that the strategic plan is now being revisited.
Right.
So the short answer is yes, but part of it is looking. One of the questions I asked Larry was about a 2-year loss projection, because that's part of the guidance in terms of forward looking and how do we integrate that. So we actually built that into our internal model for purposes of the capital plan once the budget was finalized. So, having that information and then putting it into your looking at your budget, and that's why I say overlay these results with other information that you have in hand. It's a helpful exercise, even though it's theoretical, but it's a helpful exercise because, part of the poll, very much a joke, but like how many banks would be able to withstand, not only the severe adverse scenario, but like layer in all these other things that are happening real time in the world, right? I mean, you
Yeah.
can't forecast that, but having enough capital and where you put your dollars
Yeah.
can make or break you.
No question. And this is really addressed to the participants more than the panelists. And that is what I have seen is problematic right now is that if regulators come in and see somehow a disconnect between the intensity by which your credit team or your finance team are doing stress testing and it's not showing up at the board level or not showing up or having any impact. In fact, a bank client of ours said, the regulator said bluntly, if it's not showing up in bank board agendas and minutes, it didn't happen. It doesn't matter if you told us you
Mhm.
did all this and you discussed this at the management level. If the board's not being made informed about this in such a way that it does effectively impact risk appetites and strategic plans, then we really, frankly, consider it deficient.
Yeah. And we got one more question here. It says, what does the timeline look like once you've made a commitment? How quickly can we get delivery of the analysis? I think this is one of the areas we really set ourselves apart because we do so much data ingestion in our loan review, and we've got a portfolio analytics tool. So just looking at the attendees, we've got I see some loan review clients, some of our portfolio analytics clients, and then some prospects that don't do any business with us yet. Our big value proposition is we take the data, understand it, our data team, and ingest it into our software. The timeline, once we get the data ingested and let's say we get the regulatory alert file, we can turn that around usually pretty quickly. We may have some back and forth question, but once we get the data ingestion, what we'll do, we'll set up a kickoff call with the key shareholders. That's usually like the chief credit officer, the CFO, or somebody that's really mid-level management on the credit team. Really, a lot of times it's people who understand the ACL model. And we'll have what we call an assumption development call. It usually lasts about 45 minutes. And it's me really explaining the methodology. What is a PD? What is a LGD? And I would basically say under normal circumstances, here's the probability of default that we would model for an owner-occupied commercial real estate. And here's the ranges for your peers. And I would have those collaborative discussions like, well, we actually think there's more risk in non-owner occupied CRE because we've got a heavier retail portfolio. Like we'll have discussions that I may not just can see from the data, but we'll have that assumption development call, and then we'll stand up the models, run through the analysis. And from the time that we have that assumption development call to really draft results is usually about a 2-week turnaround. We can do it quicker sometimes it takes a little bit longer, but from like engagement, from a signed contract to a delivery of results, assuming everything goes smoothly, that can realistically be a 2-week to a 4-week turnaround. And I think that is one of the value propositions. We actually have to fight sometime like vendor fatigue. We don't have to integrate within core. We don't have to map hundreds and hundreds of variables. We don't have to have these iterative calls. Just give us your data, a couple of key data points, a couple of discussions, and we can get you really, really thorough results pretty quickly. And Linnell, you can speak to that maybe. I think we went maybe even faster than that with you guys because you'd been a loan review client and you really needed it.
Yeah, I would say having direct access and using all the data that was already provided. I think we've actually done loan reviews with IntelliCredit for 3 years now. And so there was a lot of data there, as well as this was the second run at a stress test. And just to layer on to David's point, making sure that you're actually using this analysis and providing, I took some time, the speed in which they turned it around allowed me to write a memo for the board that actually looked at the key vulnerabilities and, analyzed the potential impact on our financial condition. So, back to the timeliness of all of this, and, it really worked out well. So I just want to highlight that, the expectation for community banks especially is to have the capacity to analyze this. So you got to use it and then be able to have, the board look at the stress testing to establish what the risk appetite should be for your bank.
Absolutely.
One of the things that I'd like to ask the audience, frankly, is because it based on 2 conversations I've had in the last 2 weeks, and that was, we do, shock test on LTV, shock test on rates, and we think that's going to be adequate for a stress test. Now, this is a less complex bank than Blue Ridge, but if there's any feedback that the participants could give us around whether or not you're getting regulatory opinions or comments about, because those shock tests are really variants of most what credit people think of as projections at original underwriting, right? This obviously is more post booking stress, but anyway, just if anybody would volunteer any perspective on that in the chat. I've also got another question here, since this was specific to the audience. We'll jump with that. We are a small community bank. At what size do the regulators begin to expect to see this type of analysis? Actually, that's a very pertinent to what I just asked. We are certainly seeing a sense that irrespective of size, I think Larry mentioned this earlier, that seems to be a general presumption of best practice in risk management now. The irony in that is that none of you on this call are technically required to do a stress test. You're not CCAR, you're not DFAST. size banks. The only regulatory requirement rests in those two segments, none of which are on this call today. But again, we're hearing it everywhere that that's one of the last things the examiners are saying. The next time we're in the shop, we'd like to see, and most preferably, a robust or something robust in terms of loan level.
So David, myself and another team member, Lauren Sell, who helps manage our sales, we had a call last week with a bank in the Southeast U.S., 2 branches, $100 million loan portfolio, and they just completed their state regulatory exam, and they contacted us because the regulator said, we'd like to see a loan level stress test. This was a bank that had no NPLs, no historical charge-offs over the last couple of years, like clean credit quality. It almost, the president was who we did the MOA. He said it almost felt like they didn't have anything to offer, so they said you need to be doing a stress test. So that's probably the smallest that I've seen, but sub $500 million banks, we've done a lot of demos for those because it has been the regulatory talking point over the last 12 months. And that is one thing. If you're short staffed at a smaller institution, you wear lots of hats anyway, maybe you don't have robust modeling. One of the value propositions is we can give you something fast and efficient, high value. And we do this as a service. It's not a model we're trying to sell you. So you can leverage us to basically outsource something that's going to be comprehensive, high value, and low touch for you as a whether it's chief credit officer, president, CFO, whatever.
Yeah, and I think one of the things that got underreported or misunderstood maybe in 2023 when we had those 5 bank failures, only one of which was a very small bank in the Midwest that had any credit problems. The rest of it was liquidity, right? Those 5 banks were the equivalent of about 480 banks in the financial crisis in terms of their potential impact on the FDIC insurance fund. That sent shockwaves through the regulatory. That's, in my opinion, that was what triggered the significant pivot by the regulators in the last 18 months to look at things like credit process. And they consider stress test part of good hygiene in a credit process. Because in the end of the day, unlike the shock test we were talking about against LTVs or rates, the loan level stress test, as Larry very well said, should carry over to the capital account. And in the end of the day, if we get into heightened credit stress, in my personal opinion, that's where the regulatory focus is going to be. Are you adequately capitalized? And at what point do we have a contagion of banks that are having problems in their adequacy ratios of capital?
I put in the chat the link to the bulletin that Robert, to add on to what Larry and David had said, it talks about community banks, $10 billion or less. And to David's point, I think this really, even though it's really a credit risk management tool, but the impact to other things, including capital and liquidity, is really where I think the linkage between your stress test from a credit perspective and the financial condition of the bank. So I keep going back to layering of the risk. What are the layers of the risk? And I think with those 5 banks, when you start to peel the layers back, you see that it's really much more involved than one problem loan or one, relationship, whether that be a loan relationship or deposit relationship.
Yeah, absolutely. So we're at 10:50. We want to be respectful of everybody's time. If there's any final questions, please let us know. We'll be happy to answer those for you. This has been a lot of fun to me. Even every time I listen to you talk, Linnell, I learn new things. You too, David. But this has been a lot of fun to me and really appreciate everyone's time today. David, Linnell, I don't know if you had any final thoughts or questions before we turn it over to David to close us out.
No, I would just say, there's a lot of things happening in real time. And, I would say banks are probably thinking about the impact of Doge and, what's going to happen with their portfolios as a result. So one thing, back to looking at specific asset classes, one thing that we're talking about doing is doing a targeted scope on, 1 to 4 family adjustable rate arms, just because of our location and, what's in the portfolio. So, each bank has specific, they need to do these things specific to what is embedded in their portfolios. And so, what might work for Blue Ridge or what we've done may sound, good, but you need to take in consideration your asset classes and, your budget and your capital and where you are and look at it holistically.
Yeah, a lot of people have heard me say this before, Linnell. The larger banks have somewhat mastered this a little better than the community financial institutions, and that is understanding the treasure trove of data that you sit on in your loan portfolio. That's your DNA, your very unique DNA. And as Linnell just said, there's not a single bank that has exactly the same. It's kind of like fingerprints or facial recognition. You're all different, and understanding that, utilizing the data that you're sitting on and that's why we think our approach and our methodology is also inclusive of that, encourages you to identify those uniquenesses about your bank, and it's not just a one size fits all.
Yep.
Okay, well, Larry, I don't see any additional questions, so we're going to finish with one polling question, which is, yes, a little bit of marketing and sales here. If you would like to schedule a call with us on just exploring the possibility, please indicate so in the poll, and we'll certainly get back with you. Okay, well, we won't share this with you because I think it's the point being is that it's just an outreach if you do want us to get back with you, but we certainly respect that the primary purpose of this coffee talk today is to hopefully inform. But having said that, I just want to close by saying IntelliCredit, remember, is 3 pillars of post-booking risk management in various forms of loan review. We have the Portfolio Analyzer, which, as I spoke to a moment ago, a very dynamic tool that gives you the ability to slice and dice, drill down into your portfolio, utilize that unique data that is your DNA as perhaps a non-complex community financial institution. And of course, as we've talked about for this hour, we think a very effective and very robust loan level stress test. Please reach out to us and see if there's anything that we can do to help you in further explaining that on a one-on-one basis. And as we often do, because we do a lot of coffee talks on Fridays with various topics, speaking of loan level data, our next coffee talk will be with David Littleton of our team and a very special guest, Cindy Cheng of PCBB, which is, of course, a national correspondent banking bankers bank that is many of you are probably familiar with. They use our Portfolio Analyzer, and I think the reality there is she can bring a very clear banker's perspective on how to utilize your data more effectively, as we just talked about. So again, thank you so much for coming today. We appreciate your attendance, and we hope all of you have a wonderful weekend.
And a special thanks to you, Linda. I appreciate your time.
Yeah, absolutely.
No question.
Thank you.
No
Happy
question.
Friday. Bye, guys.
Yeah, have a good day. Thank you.
Take care.